Guess what? I just came across a long-lost clip of Charlie Munger explaining the 3 things he would do to generate 50% annual returns when investing small amounts of money. The clip looks like it was shot on an iPhone 4, but it's Munger at his absolute best. If you want to build real wealth, you need to see it. There's an old saying that it takes money to make money. While that might be true, the amount of money you need to start generating high returns is far less than most people believe, at least, according to Munger. Now, let's get into the video.
Warren and you are known for saying that if you work with a small sum of capital, namely I think being $10 million, Warren had published that he could guarantee that you compound that at 50% a year. So my question is, can you provide some examples? And I would kindly ask you to provide as many examples as possible and be as specific as possible. Thank you.
Well, and then I hear somebody that really wants to get rich at a rapid rate with specifics. That is not what we're trying to do here. We want to leave some mystery so that you can amuse yourself finding your own way. You know, the good ideas that I have had in my life are quite few. But the lesson I can give you is a few is all you need, and don't be disappointed. And when you find the few, of course, you've got to act aggressively. That's the Munger system. And I learned that indirectly from a man I never met, which was my mother's maternal grandfather. He was a pioneer, and he came out to Iowa and fought in the Black Hawk Wars and so on. And eventually, after enormous hardship, well, he was the richest man in town, and he owned the bank, and so on. And he sat there in his old age growing up. My mother knew him because she'd go to his Algona, Iowa, where he lived and had the big house in the middle of town, iron fence, capacious lawns, big barns. And what Grandpa Ingham used to tell her is, there's just a few opportunities you get in a whole life. This guy took over Iowa when the land was, the black topsoil of Iowa was cheap. But he didn't get that many opportunities. It was just a few that enabled him to become prosperous. He bought a few farms every time there was a panic, you know, and he leased them to thrifty Germans. He couldn't lose money leasing a farm to a German in Iowa. But he only did a few things. And I'm afraid you're not going to find a million wonderful ideas. These people, the computer algorithms do it, but they have a computer that's sifting the whole world. It's like placer mining. And of course, every niche they're in, if somebody else comes in, the niche starts leaching away. And I don't think it's that honorable way to make a living, by the way. I would rather make my money in some other way than outsmarting the trading system, so I have a little computer algorithm that just leaches a little of everybody's trade. I always say that those people have all the social utility of a bunch of rats in a granary. It's not that great a way to make money. I would say that if you make your money that way, you should be very charitable with it, because you've got a lot to atone for. And so I don't think it's an ambition we should encourage. And the rest of us who aren't just leeching a little off the top because we're great at computer science, and that's what this room is full of. And if you're not finding it harder now, you don't understand it.
There are 3 inefficient market principles you need to understand if you want to follow Munger's advice on generating high returns with small sums of money. The first principle is to look inefficient markets. Charlie Munger is the vice chairman of Berkshire Hathaway, and as of the making of this video, Berkshire has a market cap approaching $800 billion. That makes Berkshire the 9th largest company in the world by market cap, and the biggest non-tech U.S. company in existence. To most people, Berkshire's massive size would seem like a huge advantage when it comes to investing, right? Well, actually, that's not the case. Charlie and Warren have repeatedly said that Berkshire's size is an impediment to generating high investment returns. Because Berkshire has so much money, Warren and Charlie are forced to focus only on large investment opportunities. The odds of these large investments being mispriced or, to use an investing term, inefficient are extremely low. On the other hand, there's a much higher probability of inefficiencies occurring when the size of the investment is much smaller. Large investors like Berkshire are too busy chasing big opportunities to even notice these small ones. And this right here is where your opportunity comes in. Now, listen to Charlie Munger's business partner, Warren Buffett, explain this concept.
I was working with a tiny amount of money. And so I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that were just ridiculous. They were ridiculously cheap. And obviously, as the money increased, the universe of possible ideas started shrinking dramatically.
When Warren and Charlie were investing small sums of money decades ago, they had to spend thousands of hours pouring through tens of thousands of pages of financial reports just to find one potential idea. Thankfully for us, the internet has made sourcing potential mispriced stocks a heck of a lot easier. All you have to do is jump onto a stock screener like this one, and you don't need anything fancy. A free screener will do just fine. All you need is a screen that can filter by market cap and PE ratio. Set the market cap range to $10 million to $200 million, and the PE ratio range from 3 to 15. The companies that meet this criteria will be small by Wall Street standards. Most professional investors have restrictions that prevent them from investing in stocks below a certain market cap. For example, the fund I work at in New York City has a rule that we can't invest in any company below a $5 billion market cap. This restriction means tons of potentially great investments slip by us, simply because these companies are too small. Additionally, companies of this size are often uncovered by Wall Street analysts. Compare that to a company like Apple. Its stock is covered by 31 Wall Street analysts, each monitoring the company's every move. The fact that virtually nobody is paying attention to these small companies increases the probability that you can find a stock trading well below its intrinsic value. Take big swings before we get to lesson number 2. Make sure to hit that subscribe button because it's so important to spread the teachings of people like Charlie Munger to as many people as possible. Learning from Munger and other investing legends has positively impacted my life, and I know it can do the same for you. The next lesson from Munger is simple. Take big swings when a good opportunity comes along. The logic is that great opportunities are rare, so when they appear, you have to take full advantage. This point can be demonstrated using an analogy from baseball. For my non-US viewers, baseball is a bat and ball sport played between two teams. In the game, one team throws a small round ball at a player from the other team, who then tries to hit it with a bat. The goal of the batter is to hit the ball in a way that allows his team to score runs, also known as points. According to Munger, there are lessons from baseball that can help you make money in the stock market. One of the greatest baseball players of all time was Ted Williams. He wrote a book called The Science of Hitting, which contains a compelling illustration of him at bat with the strike zone divided in 77 distinct squares. Williams recognized that by waiting for a pitch in his sweet spot, he could significantly increase his chances of getting a hit. Being patient and waiting for the right opportunity offered about a 40% hit rate, while impatience could lower his success rate to 23 to 25%. Williams understood that average batters turn into great ones when they wait for the right pitch, and even the best batters become average when they swing at the wrong one. Munger firmly believes this concept also applies to investing. As an investor, you're faced with thousands of potential investments every day. Think of these as pitches in baseball. To succeed, you must be patient, sitting with your bat on your shoulder, watching pitch after pitch go by. Only when you see an opportunity perfectly in your sweet spot should you swing. The problem is, these perfect pitches aren't common. It can take months or even years before you find one. That's why, when that perfect pitch finally comes, you have to make the most of it and swing for the fences. Don't be afraid of a concentrated portfolio. This ties perfectly into Munger's third lesson. Don't be afraid of a concentrated portfolio. Conventional investing wisdom says you should have a highly diversified portfolio, dozens, even hundreds of stocks. But Munger believes that's incredibly foolish if your goal is to generate high investment returns. Munger has the vast majority of his family's entire net worth in just 3 investments: Berkshire Hathaway stock, Costco stock, a fund managed by investor Lee Lu. Instead of diversifying widely, Munger advocates for a concentrated approach, focusing on a handful of outstanding businesses you thoroughly understand. By deeply studying and comprehending these businesses, you can make more informed decisions and increase your odds of exceptional returns. The John Arrillaga often uses the story of his friend John Arrillaga to demonstrate this point. John Arrillaga is a billionaire investor. Naturally, you'd assume his net worth comes from a wide mix of assets, multiple businesses, dozens of properties, countless stocks, but that couldn't be further from the truth. Arrillaga made his fortune in real estate, but he took a super concentrated approach. Instead of diversifying, he chose to focus exclusively on buying real estate within 1 mile of Stanford University's campus in California. Over a 40-year period, all Arrillaga did was simple. He never took on too much debt. When prices went down, he bought. When everyone else got euphoric, he sold. That's it. As Arrillaga built his billion-dollar fortune, he was offered countless investment opportunities outside that 1-mile radius, and he ignored them all. He stuck to what he knew best, and that focus gave him a massive advantage over the competition. As a result, he became one of the wealthiest people in the world. As Munger once said, "I would be a heck of a lot poorer if I followed conventional financial theory." So, there we have it. Make sure to like this video and subscribe to the channel, because my goal is to help you become a better investor by learning from the world's greatest investors. Talk to you again soon.